So it's time for a change. It's time for a revolution, as I like to call it, and I would love for you to be a part of it. Now, I want to welcome you to a complete new series called Market Mastery 2024. And before we actually dive into the material, I want to go quickly over two things. With the first thing being that this is a follow-up of the A to Z guide, meaning that certain things I might not mention in this series. If I do not mention them, they are likely already mentioned in the A to Z guide. Second thing being is that I want to give credit where credit is due. So thank you to ICT, the man himself, for teaching me the basics. With that being said, I also want to mention that everything that I'm going to be teaching here is based on my own understanding. And the discoveries I made are made through my own studying. I wasn't in a secret group. I wasn't privately taught by ICT or anything. The things I achieved in my trading have been achieved through my own studying. And you can do the exact same thing. With that being said, welcome to Market Mastery and let's get it started. First thing we see here is, of course, Market Mastery by Arjo, by me, the community MMT money making team. Now, if we move on to section 1, the first thing we need to understand is how the market moves. Well, when the market is moving, it is either doing one of two things. It is seeking liquidity or it is offering fair value. Offering fair value, also known as rebalancing. There is no particular order in this, although there is a cycle that we are going to go over later on as well. But not one is more important than the other. So the 1 and the 2 you see to the left of seeking liquidity and to the left of offering fair value, they are just to show you that we are either doing one of these two things. Now, what actually is seeking liquidity then? That is where we move on to section 2. What is seeking liquidity? First thing we need to understand is we need to define things. In Market Mastery and in general, my teaching style is defining things. Seeking liquidity means that we are seeking something. What are we seeking? We are seeking liquidity. What is liquidity? Liquidity is buyers and sellers. In the market and the way the market works, any market, I'm talking about futures, I'm talking about Forex, crypto, whatever you can think of, whatever you can trade, we always need a buyer if we want to sell something. And we always need a seller if we want to buy something. So if we want to buy a new car, then we need someone that is willing to sell that car to us. And if we want to sell that same car, we need someone that is willing to buy that car off of us. Understanding this is the first part of understanding liquidity. Because in the market and in any tradable market, there is huge institutions involved. There are people, and when I say people, I mean central banks, I mean institutions that have a crazy, unfathomable amount of money. So if they want to open up a position, they can't just open up a position by clicking the buy or sell button. Whilst we, me and you, and our neighbors, the average Joe, can just click buy and sell and will get involved in the market. But those institutions, those central banks, let's say they want to buy a position size of 1,000. So 1,000 positions. Then that means they need to buy those 1,000 positions off of sellers. So who is going to sell to them? Do they just go around asking, hey, I'm looking to buy 1,000 positions. Are you willing to sell something to me? No, they just take it like that. So they need to create the opportunity for sellers to come into the market. That is done through taking people out of the market and tricking in new market participants as well. So whenever a price is seeking liquidity, it is seeking an opposing buyer or seller to get involved in the market to be able to place a position in the market to their own benefit. That liquidity, where is that? Liquidity is above swing highs and below swing lows. So the swing high you are seeing to the right side of our screen is where above we have liquidity, and the swing low below that swing low we also have liquidity. That 3 candle pattern. That is then what we define as our liquidity points. Now, what does this actually look like in a chart? Here we are on the dollar, and in the dollar we can see that we have certain swing highs. We have this swing high, we have this swing high, we also have this swing high sitting right there. Now we can notice something, that this swing high got traded above, got taken out, got swept before we continued lower. So if we focus on that swing high and we remove the other ones, then what is happening right there? Well, again, remember what we said. All right, let's say we want to get involved. And again, when I say we, the central banks, institutions want to get involved with a position size of 1,000 and they want to sell. But there seems to be a lack of willing buyers currently in the market. So what do we need to do? We are now tricking in new buyers and we are taking out early sellers. What? How does that make sense? Let me explain. Above this swing high, what are people doing? Well, certain people are already in a sell position. Where do people that are in a sell position place their stop loss? Above recent swing highs. So above this swing high, there are stop losses. In a sell position, a stop loss is a buy stop. Meaning that if we were to sell right there, this is a sell order. And we are expecting price to go lower. When we are not correct and price hits our stop loss, that is actually a buy stop. So the stop loss of a sell position is a buy stop. Meaning that if your stop loss gets hit in a sell position, you are actually buying that back at a higher price, at a loss. So this is where early sellers get taken out of the market. But not only early sellers. Because again, we are also tricking new people into the market. How are we tricking new people into the market? Well, if we trade above a swing high, you could make the assumption that potentially there's a shift. There's a shift in the market to go higher. Because clearly it is showing momentum to potentially go higher. So what do people do at that level? Well, bigger institutions, financial institutions, they are known for momentum trading. So they just simply follow the trend. And if we want to buy on momentum right there, then what will we do? Well, we first want to have a significant shift of the momentum. The significant shift of that potential momentum changing is above that swing high. So this swing high is where they would place a buy stop. And again, a buy stop is when we trade above that level, is when you get filled. So right there, that is where a buy stop would be filled. So we have two quote unquote willing buyers to match our sell order. We have now generated liquidity. We were seeking liquidity and we found it. What now? So what is actually now the next step? Because we found the liquidity, what do we do now? Well, if we want to make profits, because let's say the central banks, again, we're getting involved on that sell right there. Their sell positions finally got filled. Had their stop loss somewhere around there, targeting lower. Then what are they targeting actually? They are again targeting liquidity. Because if we're in a sell order, our take profit is again a buy. Now it gets flipped around. Now if we target those swing lows, there are willing sellers that we can match with our take profit with our buy order. So this swing low, for example, is where people are willing to sell. Again, who are those people? Well, those are momentum traders. So people just trying to catch the momentum right there, which they did quite successfully. And we sell our position to them. But not only to them, because we obviously also sell to this person that was still in that buy. And that is where it gets interesting. Because once we take that buy stop right there, once we take those buy stops, we want to suffocate this position, meaning that we don't want to give them a chance to get released, meaning that we don't want to give them a chance to go break even. We don't want to give them a chance to hit take profit. Why is that? Because we need their liquidity. If they are out of the position, then their stop loss right there on that buy order is not going to be there anymore. And if they are still in that position, then we can use their stop loss as someone to sell to for our take profit right there. So we need this order right there to suffocate, not giving them a chance to get out of it. Then we have used their buy stops as both. Then we are doing the exact opposite as them. We have used their buy stops to get involved in a sell position. Now we are using their sell stops, so they will sell that stop loss to us, and we are those willing buyers. So whenever we refer to buy side liquidity, we are referring to buy stops. Whenever we are referring to sell side liquidity, we are referring to sell stops. And understanding this picture is having a great understanding of where people are trapped and where they should not be released. That is the first understanding of where price actually might want to trade towards. Because if this buy stop got released and we went higher right there, we were not respecting that swing high. The definition of respecting a swing high is what we'll touch on in a different video as well. If they were released, then we would have likely gone higher. As we can see, people in a sell stop position right there, they are clearly not getting trapped, right? They have the momentum going for them. So if that is the case and they are not getting trapped, then clearly price is still willing to move lower. So coming back to the PowerPoint is, why does the market seek liquidity then? That question is for you. So that question is where I trust you that you can now answer that. So coming back to the PowerPoint is where we now have the question, why does the market seek liquidity? I trust that you can now answer that question. So please feel free to write down your answer. And then we can move on to section 3, where we now go over what is offering fair value. Again, we are defining it. Offering fair value. What are we offering? Fair value. What is fair value? Well, fair value, the first word in that is fair. So something is fair. What is not fair in price? All right, that is where we go for the first bullet point. Unfair price action. When we talk about unfair price action, we talk about a one-sided move. So in the top right of our screen, we see this line going higher. That is unfair price action. Why is that unfair? Because only buy side got a chance to get involved right there. There were only buyers getting involved. So we need to give a fair chance to sell side as well to get involved. And that is where fair price action comes in. Because on the second example, we see on the line going higher, then the line going lower a little bit. That is where we are now creating fair price action. We are offering fair value right there. And when we offer that fair value, we have offered both buy side and sell side. How do we know that fair value has been offered overall and that we are done offering fair value? Because that is where the third example comes in. Once we have a move higher and price is allowed to move higher, that is when we have offered fair value. That is when the sell side move right there is where price gave sell side a fair chance to get involved. So that area is now called fair value. The gray box is a fair value box. And that fair value box is, of course, if that is already fair value, then there's no real reason to return all the way to that box, right? Because why not? Well, price is already fair value. So if they are coming back to that box and they are retracing very far into the gray box, then it's likely not offering fair value anymore. It is seeking liquidity. So what does that look like in the chart? Well, before we dive into the chart, I want you to remember the 3 swing move. 1, 2, 3. That is what we're going to be focusing on. All right, here we are on ES. Now, if we remember that 3 swing movement, what does that look like in the chart? We see here on ES, we have this swing movement. And overall, again, when we are offering buy side, I just simply look at what are we overall doing? Are we moving higher or are we moving lower? If we're offering buy side, we are overall moving higher. Sell side overall moving lower. There's no need to overcomplicate this. In this move right there, we've overall gone lower right there. It doesn't have to be consecutive down candles or consecutive up candles. That depends on the relativity theory, which we are going to get into in a later video. So here on the first swing higher, we offered buy side right there. This first swing higher, we offered buy side. Now, to give a fair chance to sellers for them to as well get involved, we're also going to offer sell side. So this area right there is where we now offer sell side, which means that the whole leg right here is where we already offered fair value. So there's no reason to retrace very far deep into this fair value box sitting right there, which is the exact thing we see because we have a sting into the fair value box and then we continue higher immediately. Because the only thing that was not fair value at this moment in time was the area above the fair value box. So the retracement is going to happen here before we actually continue higher again. The upper gray box was at that moment in time not fair value. It delivers lower, delivers that sell side to offer the fair value again, and then it moves higher. And the same thing happens right there, because here we have move higher, 1, 2, 3, that 3 swing movement, which creates this sell side sitting right there, which is again the new fair value box. So this is our fair value box where fair value was already offered. Everything above it right there at that moment in time was where we didn't have fair value just yet. So this, and we can see the exact same thing again right there, sting into it and we continue higher. Now, before we move on, why am I ignoring this long wick? Why am I ignoring this small retracement right there? Why am I taking the bodies right there? Why am I taking the wicks right there? All things that we are going to go over later on as well in a different video. So don't worry, I'm not cherry picking. There are rules to that, but I first need you to understand this. Then after we have the same exact thing, the 3 swing movement. That is important. Why do I mention that 3 swing movement so much? Because if you get ahead of yourself and you look at every single swing in the market, then you could make the argument, well, Arjo, isn't the whole market already fair value? We've already been everywhere. Yes, exactly. But the market is focused and price action is focused on the most recent price action. So the last 3 swing moves, which we can see again right there. 1, 2, 3, right there. And after that, we take this fair value box and we can see we tap into it and we continue higher again. Off of this fair value box, we continue higher and we again have this new fair value box. Now, this fair value box is quite interesting because right now we are not respecting it. So price is coming very deep and is even going below this gray fair value box, which it shouldn't do, right? Because it already offered fair value right there. So there's no reason to come back. There's already fair value. Then why is it coming back? Well, what is the other reason price is moving? It's seeking liquidity. So all these gray boxes right there, there's already fair value in the market. So they are not returning to offer fair value. They are returning to do what? To seek liquidity. Where now the lows of these gray boxes right there is where we have swing lows sitting right there. And that is exactly where we are now seeking the liquidity. With eventually this ultimate low right there. And now we have already, just by understanding how the market moves, we understand where the market might want to trade towards. So if this is our ultimate target right here, then how are we going to deliver towards that target? Same exact manner, the 3 swing movement. 1, 2, 3. And what do? We have the fair value box sitting right there. We also have what? If you're already a bit more experienced, you can also see we have a breaker. Again, all things we're going to incorporate as well in later videos. Off of that, we create a new fair value box because we again have 1, 2, 3. And then right there, we have this fair value box, and that fair value box gets respected perfectly, sting into it, small sting into it, and we continue lower off of that, creating a new fair value box sitting right there as well. And we continue lower off of that, sting into it, immediately continuing lower, targeting that liquidity right there. So the fair value box in overall bullish price action, as in we are going higher, is a sell side fair value box before the new move higher. So it's 2 buy side swings and 1 sell side swing in the middle, With bearish price action, it's 2 sell side swings and 1 buy side swing in the middle, and that creates the fair value box. So just by this understanding of seeking liquidity and offering fair value, we have a great understanding of where the market will likely trade towards. So the question here, why does the market offer fair value? That is again a question to you. Can you answer that question? Once you've answered that, we move on to section 4, where in section 4, we ask ourselves, why do we need to know this? Because this is the basic understanding of the first step that we need to take in order to get to a trade ID. Any first step before you actually execute a trade, before you actually make profit or you take a loss, is you determine a bias. A bias is defined by a bias equals direction. So is the market going higher? Is the market going lower? That is your bias. Then the bias aims for something. Bias equals direction. Direction is a draw on liquidity. So with your bullish bias, you are always looking to target a premium array. With a bearish bias, you are always looking to target a discount array. Where in the example on ES, when we were targeting lower and we were targeting those fair value boxes, they were swing lows, right? When we were seeking that liquidity. We had a bearish bias determined by seeking liquidity and offering fair value. The draw on liquidity was the swing lows, which is a discount array. And when we were looking at bullish prices on ES, we were targeting premium arrays because we had a bullish bias. And that also leads to the understanding of the cycle between seeking liquidity and offering fair value. Because we understand that it's either seeking liquidity and offering fair value. So if it's not seeking liquidity, it's offering fair value. If it's not offering that fair value, it becomes quite easy because we understand we are seeking liquidity now. And there's also a cycle, which we'll go over in a later video, where usually when we seek liquidity and we have found liquidity, that is when we start offering fair value. And when we have offered fair value, we now start to seek liquidity. Again, mentioning the ES example, when we offered fair value, we were looking to target a premium array in the form of those swing highs, targeting, in other words, liquidity. When we took liquidity, we were again offering fair value. It's a constant cycle. But the next section is probably the most important one to understand. Because section 5 is where we now need to understand how can we actually make money with this understanding. But the first thing being is that this is a game of probabilities. It's all probabilities. Nothing in the market is binary. Usually, and I've also been through that. I've also had that experience, is when I came into the market, I thought when someone taught me something, I learned a kill zone or something, I thought that needs to work 100% of the time, right? Because that's also the way it is instilled into your mind. It's also the way they teach it. And I'm here to tell you that, just a quick warning, it's all a game of probabilities. Nothing here is binary. So everything that we're teaching here has a higher probability of happening over the other thing. When I say high probability, it does not mean it's guaranteed to happen. So when I see people trying to disapprove of certain strategies by saying, but it didn't work here. Yes, okay. We are also going to lose. We are also going to have losing trades. So by saying that is essentially saying that you do not understand the basics of the market, which is understanding probabilities. It's all probabilities. And yes, we are also going to lose trades. Keep that in mind. Then the next thing is that the market isn't random belief. The market isn't random is a dangerous belief to have. Probably the first time you came into this smart money concept niche, you were told the market isn't random. Again, to a degree, I agree with that. But having that belief implies that there's always a reason for something happening. There can always be an understanding. There can always be a rational, logical explanation of something happening in the market. We can always see what is going to happen as well. And then that implies that you can have a 100% win rate in the market. So this belief is very dangerous, because if you think that you are going to have a 100% win rate, then you do not understand the first thing we went over, that it's a game of probabilities. Nothing is binary. You're never going to have a 100% win rate. Maybe in your first 2 trades, yes. Maybe in your first few trades, yes, perfectly, of course. But you're always going to lose a trade sooner or later. So believing the market isn't random is a dangerous belief. And this is why smart money concepts is such a dangerous niche to be in. Because everyone is trying to teach you this next shiny object syndrome, this next best thing. Again, we need to understand, and this is what I want to make very clear, when I talk about liquidity as well, and when I talk about, they are taking these people out of the market, they are taking those strategy traders, momentum traders out of the market, support and resistance, I am not making fun of them. Those people are not any worse than us. We are not better than them. We trade differently and we need to respect that. But when I see on social media a quote like, you are my liquidity, I'm targeting your liquidity, I'm taking your liquidity, it's like, all right. You need to understand that support and resistance traders, those momentum traders, they are trading with serious money. More money than the usual smart money concept trader. Now, if we can take that understanding, why are they making so much money? Why do they have so much money and smart money concept traders don't? And we combine those and we combine that knowledge, then we can get to insane results. And that is exactly market mastery. So again, just understanding as well, we are not better than them. They are also not better than us, of course. We're equal. We're just humans. No one is superior. No one is inferior as well. And that leads me to the next thing, is that we are focusing on the basics. And our basics are extremely advanced, where this was only the first step in understanding market mastery. We can get so in depth on the basics, it's scary. And that is exactly what we want to do. So with that being said, I think you are ready for a beautiful series ahead, market mastery. Let's make it a great one. And again, I need you in that as well. I will try my absolute best to teach it as best as I can. And please, if I can help through going over case studies or anything, then please feel free to let me know through Twitter, through the Sunday weekly live streams. And now I believe you are ready for market mastery. The first step has been taken, where if we want to succeed, both of us, we need each other. I am going to do my absolute best to teach it as best as I can. I also need you. I need you to study it. And if I can help with certain case studies, etc., then please feel free to let me know on Sunday during a live stream. Feel free to let me know and tag me in Twitter, for example. And then we'll work on that as well. Then I want to thank you and I'll see you at the next one. Perfect. Thank you.